Okay, so let's open up Work Together 11-3. And there's two transactions that deal with declaring dividends and paying cash. And you'll notice that they are two different months because remember, we declare dividends one month and then we pay them the next once the board of directors decide what they want to do. Okay, it says on December 15th, the board of directors declared dividends of $2 per share. Capital stock issued is 6,000 shares. So each of these 6,000 shares is worth $2 each. So 6,000 times $2 each is a total of $12,000 dividends were declared. Dividends are declared. Two accounts are affected, your dividends and your dividends payable. We're identifying the amount of our dividends. Remember, dividends has a normal debit balance. Our dividends payable, it means that it's going to be credited dividends payable because we owe that money to our stockholders. And eventually in a month, we are going to pay it. Again, once the board has declared dividends, they have to pay the amount. Okay, so our first transaction on December 15th will go in our general journal. Because when they declare dividends, there's no cash payments, there's no cash receiving, no sale, no purchase, so it goes into our general journal. The date is December 15th. Document number is Memorandum 112. The amount of our debit is going to be $12,000, and this debit is going to go to dividends. Okay, that is the amount of the dividends that we declared. Dividends has a normal debit balance, so we're increasing the total amount of our dividends. Eventually, this is going to be taken out of our retained earnings, which is our total earnings that we earned in the fiscal period. Our credit amount then of $12,000 is going to go to our dividends payable. Okay, and this amount will increase the amount of dividends payable, and that's the amount that we have to pay to our stockholders within the month. Okay, then it's January, a month has passed. Okay, we're going to pay cash for dividends declared. Since we're paying cash, we go to our cash payments journal. The date is January 15th. The account's title is dividends payable, so it's like with our accounts payable. When we pay it, it's going to go down. Same with our dividends payable. Okay, check number, we're writing out check number 556. Remember, we write that out to an agency such as a bank, and they will make payments or automatic payments into the individual stockholder's account. Okay, your dividends payable is a liability. Since we're paying it off, it's going down, so we will debit it for $12,000. We are paying cash. Okay, paid cash for a liability, which is our dividends payable. And again, that gets paid to a bank, and a bank will distribute the dividends. So again, this one is for declaring dividends. The board of directors decide to use some of the retained earnings, and then this one is a paid. And remember, it is a month apart.